Okay, hello everyone, and welcome to this webinar brought to you by FX Street. My name is James Chen. I am the Chief Technical Strategist at FX Solutions. And today we will be talking about, as I always do every month, finding potentially high probability trading setups. And today what I'm going to be focusing on are our momentum setups that are connected with price oscillator divergences. This is a pretty big subject within the realm of technical analysis, and I believe are very useful tools in informing your potential trading opportunities. So we're going to be talking about that today. If you have any questions, please feel free to type them into the chat window. And with that, let's get started real quick. Okay, before we get started, just a quick important notice. Forex trading involves a substantial risk of loss and is not suitable for all investors. This information is being provided only for general market commentary and does not constitute investment or trading advice. These materials are not intended as an offer or solicitation with respect to the purchase or sale of any financial instrument and should not be used as the basis for any investment decision. Past performance is not necessarily indicative of future results. And of course, do not invest money that you cannot afford to lose. I'm going to leave that up just for a few seconds and then we will move forward. Okay, as I mentioned, today's topic will be Forex price oscillator divergences. I'm going to give you a little bit of background here. Some of you may have heard me speak about this before, and I do revisit divergences quite often only because they're one of the key tools in my trading arsenal, if you will. So, I talk about divergences in conjunction with my other technical analysis tools. And it's very useful in terms of when you're looking for divergences and how they may contribute to your making a decision whether or not to get into a trade and whether or not to get out of trades. So I do talk about divergences a lot, and I'm going to be providing you with background information on it, as well as giving you some key examples that are on the charts of divergences between price and oscillator. Now, I would like to make it clear here that when I do use divergences, which is very often, what I'll do is that I will couple them with other aspects of my trading, including, of course, support and resistance, the trend, as well as candlestick patterns, chart patterns, and also other uses of the oscillators, and you may be familiar with the way I use oscillators. So we'll go over that in a minute. Okay, let's go forward real quick. Now about divergence trading. Divergences are essentially imbalances or disagreements where extremes in price and the extremes in an oscillator diverge in relative direction. So oftentimes you'll see a higher high in price, and then you'll see a lower high in the oscillator, and that is talking about potential, that's a divergence, and a potential turn to the downside. Okay, good. Chuck, hi Boyke, how are you? And Chuck, I'm glad that you use them as well. Now, these divergences are used primarily as warnings or confirmations of significant potential price events. Now, what are significant potential price events? These could be a reversal. In the case of regular divergences, they could be reversals. They could be a consolidation after a trend, or they could be a trend continuation in the case of the hidden divergences, which I'll go through all of that in a minute, as well as show trade decisions that are derived from other technical and or fundamental trading methods, as I mentioned. Divergences add rationale for any trading decision. They contribute to what I call, or what's called, confluence, which is a coming together of different technical factors, providing you with additional rationale or stronger rationale for getting into a trade or getting out of a trade. Okay, so divergences, as you'll see, often appear early, so they can serve as prior warning indicators of, let's say, potential turns in the market. Now, divergences are anomalies. Usually, when you look at price and you look at an oscillator, you'll see that the price in the oscillator in terms of the highs and the lows, they should mirror each other. So if you have a higher high in price, then you'll often see, most often you'll see a higher high in the oscillator as well. Now, when divergences occur, that's when there's an anomaly that occurs. So there's an imbalance, a disagreement that may potentially be corrected by a price event. And for example, a price event being a reversal or what have you. Okay, so they're very important in that respect. Now, a lot of people ask me, in terms of oscillators, why do you often talk about oscillators? Well, oscillators, I am essentially a price action trader, and I have many, many strategies that I use. But why do I use oscillators? Because they're, for me, they're a very strong tool in helping to confirm the potential direction that I'm looking at, as well as entry levels, exit levels, and what have you. So although oscillators are what everyone calls lagging indicators, they definitely are. They are mathematical derivatives of price. So how could they lead price? But at the same time, they could be extremely useful. They can be extremely useful in helping you decide on a direction of your trading, helping you decide on entries and or exits in your trading. So that's why I use oscillators as another one of my key tools when I trade. And for those of you who've heard me speak before or know, what I do. Hey, Joseph, how are you? I don't know if that's really you, Joe, but Joe's a very, very good friend of mine. Anyway, so if you put this together with your other tools, then that's what we call confluence, and that's really how you should be using oscillators. Now, there are two categories of divergence that I would like to go over today, and these are the main categories of divergence. The first one is regular, and the other is hidden. Now, in terms of the regular divergence, this is what most people think of when they talk about and when they hear about divergences. And regular divergences are essentially what they're looking for are reversals in the market. So you have a bearish divergence, let's say. Okay, first you have a trend, then you have a bearish divergence. And most often what you'll be looking for on a bearish regular divergence is a reversal to the downside. Vice versa for a reversal to the upside after a downtrend. And I'll show you all this on my charts in a second. The second primary type of or category of divergence is called hidden. Okay, so hidden divergence talks primarily about a continuation of the trend. Okay, so within these two categories of divergence, regular and hidden, there are four types. One is bearish regular, bullish regular, bearish hidden, bullish hidden. I'll show you all of that in a minute. Okay, now how do we measure divergences? Well, essentially we're using price, of course. We're taking the price and then we're measuring the price against an oscillator. So this oscillator could be anything you may use, including stochastics, RSI, CCI, MACD, MACD histogram, ROC, which is rate of change, Williams %R, which is basically the fast stochastics, or really any other indicator oscillator that travels between horizontal bounds. And what I tend to use a lot are the stochastics, which I'll show you in a minute. Now, on both price and oscillator, we're going to be using the trend line drawing tool to compare heights of swing high to swing high for the peaks, or swing low to swing low for the valleys or the troughs. Okay. Also, an equal high and equal low can also be part of a divergence. Okay, so let's talk about the types of divergence. I'm not going to go through this slide here at length because I have it in a graph right here. Okay, so we have a bearish regular divergence. This is a depiction of a real chart, and I'm going to show you my real charts a little bit later. But for now, let's try to get this really down pat in terms of what exactly is bearish divergence, what exactly is bullish divergence, what exactly is regular divergence, and what exactly is hidden divergence. So let's start off with bearish regular divergence. Okay, so very simply, and if any of you want my slides afterwards, please feel free to email me at jchen@fxsol.com. That's jchen@fxsol.com. Okay, so bearish regular divergence is simply on price you have a higher high. On the oscillator you have a lower high. This happens to be the RSI on the bottom here, okay, the relative strength index. So you have a higher high on price, a lower high on the oscillator. Now, what is this telling you? Essentially, what this is telling you is that perhaps there is there may be a loss of upside momentum. So we have a higher high in price. This means that price is moving up. Price is continuing the trend. Okay, so we have a higher high here. Now, on the RSI here, oscillators all, their primary purpose is to measure momentum. Okay, and overbought and oversold conditions. So in this case right here, we have a higher high in price. Price is going higher, but the oscillator is showing a loss of upside momentum by showing a lower high. Okay, so that's what's called a divergence. And in this case, it's called a bearish regular divergence. Now, what is this telling you? This is telling you that although price is making a higher high, the momentum, the measured momentum, is showing a loss of upside momentum by showing this lower high. At that point, that's a warning or a potential confirmation of a loss of upside momentum and a potential reversal to the downside in this case. That's why it's called bearish regular divergence, okay? So hopefully you all understand that. Now, let's move forward real quick. Let's go to the next one of 4. Okay, so we got bullish regular divergence, which is essentially just the opposite of bearish regular divergence. Bullish regular divergence, we got a downtrend. We got a lower low in price. Okay, so price is moving lower, but then we have a higher low in, this happens to be stochastics, a higher low in the oscillator, which is showing us, or which is suggesting to us, that perhaps there is a loss of downside momentum and perhaps a move to the, a reversal to the upside or a move to the upside. Okay, so once again, lower low in price, higher low is higher low in the oscillator is a potential loss of downside momentum and a potential turn to the upside. So that's called bullish regular divergence. Okay, turn to the upside is a reversal to the upside, and that's possibly a change in the sentiment in the market, a change in the direction in the market, and a potential reversal. Okay, now let me make it clear here. Let's go back real quickly. We got the bearish regular divergence and we got the bullish regular divergence. Now that turn may just be, these reversals may not be reversals. They may be turns, and they could either be reversals or they could be, a break in the trend. Okay, they could be a consolidation zone. Okay, they could be a pullback. Okay, we're not absolutely sure when this happens if it's going to turn into a bona fide reversal, or if it's going to turn into just a correction, or if it's going to turn into just a consolidation. Okay, but this is giving you some key clues that perhaps there might be a change in direction. Okay, so that's bullish regular divergence. Now, let's move forward real quick, and let's talk about hidden divergence. I don't want you to get confused here, but hidden divergence is sort of the opposite of regular divergence. 2 types of hidden divergence. Number 1 is bearish. Okay, so what are we talking about when we're talking about hidden divergence? We're talking about a trend. Okay, so first of all, we have a downtrend. In this case, it's a lower high in price. Okay, this is bearish hidden divergence, a lower high in price. And in a downtrend, what does a lower high in price signify? Or what does it tell you? Basically, what it's telling you is that that's a trend line, as you can see here, okay? So a lower high in price, this is downtrend resistance, okay? If you take a look here, if you connect the highs in a downtrend, you have lower highs. Okay. Now, if you have on the oscillator, this happens to be RSI, if you have on the oscillator a higher high in the oscillator, that's called hidden divergence. And what does it signify? What are the clues it's giving you? That perhaps price will continue the trend. Okay, the lower highs, price will continue the trend. So it's the opposite of regular divergence. Now, what is the rationale behind this? Well, first of all, okay, you take a look here. We have a lower high in price. Okay, so price is lower here. Now, as I mentioned before, what is the primary purpose of oscillators? First of all, it's talk about momentum. Okay. Second of all, it's going to talk about overbought and oversold. Now, if you take a look at this oscillator, this RSI here, on the lower high, it's saying that is overbought. Okay, on the RSI, it's higher than the last high. Okay, on the oscillator, so it's telling you that this lower high in price is overbought, and perhaps we'll see further lows. Okay, a continuation of the downtrend, as you can see here. Okay, so that's the rationale behind that. The rationale is slightly different from the regular divergence. I hope this is not confusing you. If it is, please ask me any questions. Feel free to type into the chat window. Okay. Now that's bearish hidden divergence. So again, lower high in price, higher high in the oscillator. That talks about a potential continuation of the bearishness. That's why it's called bearish hidden divergence. Let's go to the last one here. Bullish hidden divergence. What is bullish hidden divergence? Well, simply what it is that it's just the opposite of bearish hidden divergence. You have a higher high in price. Okay? So, I'm sorry, a higher low in price. You have a higher low in price, and what does this signify? This is uptrend support. Okay, uptrend support, as you can see here. Now, on the RSI here, we have a lower low in price. In the oscillator. So that is a hidden divergence. Why is it bullish? Well, what is this telling you once again? We have a higher high in price, but on that the higher low in price, I keep getting this confused, but you have a higher low in price here. Okay, and this lower low in the oscillator is telling you that higher low is relatively oversold, and that's why we're looking for a continuation of the uptrend, as we can see here. Okay, if that makes sense. I think I'm confusing myself here. So we have a higher low here, a lower low in the oscillator. That's telling you that the relatively higher low in price is relatively oversold. And therefore, we're looking for a potential continuation of, higher lows in the price. Okay. Hopefully that makes sense. Let me go back real quick, just to do a quick review, and then I'll show you my charts. And any questions you have, please feel free. Okay. Now, one point I wanted to bring up here. Chen, what time frame works better for divergences? Everything that I talk about, every seminar, webinar I give, and the writing I do, and the trading I do, and all of that, all the strategies that I use, and all the technicals that I use, and all that, can be applied to all time frames. So it's what we call fractal. In terms of the technicals, any strategy that you use, any technical strategy that you use, any technical phenomena that you use, any technical tools that you use are, generally speaking, what we call fractal, which means they can span any time frame. So whether you're a 5-minute trader or chart trader, or you're an hourly chart trader, or you're more of a daily or even a weekly, all of these technical phenomena should or do occur on all these different time frames. Okay, so it's really up to you what time frame you use. I'm going to be showing you hourly charts as well as daily charts. Okay, I generally speaking do not go lower than the half-hour chart. Some of you may be like 1-minute chart traders, and yeah, you'll find divergences work on those as well. At the same time, however, I find, it's of my opinion, that there's too much noise on the 1-minute chart, the 5-minute charts, and any of those really lower term charts, time frame charts. Too much noise to really effectively apply a lot of this. But all of these technical tools should work on different time frames. Okay, Ray, James, is this to identify the trend or determine your entries and exits? Both. Okay, both. This is essentially, Ray, that's a great question. Are divergences to identify the trend or to determine your entries and exits? They're really both, but what divergences excel at doing are showing you the direction, okay, showing you potential trends or changes in trends. Okay, so in the case of regular divergence, you're looking for turns in the trend. You're looking for reversals in the trend. In the case of hidden divergence, you're looking for a continuation of the trend. Okay. Now, how does it determine your entries and exits? Well, if you are able to pinpoint areas where price may turn, those are potentially and arguably the best places to get into any type of a trade. Because if you could find a turn, then in terms of your risk management and all that, then you have a better place to get in. So, for example, I talk a lot about getting into trends on pullbacks. So when you see a trend and then you see a pullback move, and you see that pullback move turn back to the upside, let's say, okay, at that point, when you have evidence or when you have a hint or an indication that price is turning back to the upside, at that point, could be a good place to get into a trade. And I use a lot of what I call entry filters to get into that type of a trade. Now, when you're able to do that, then you could place your risk management or your stop loss right under the low of that pullback. So if you are able to identify turns in the market, whether they be reversals or whether they're pullbacks or corrections or the recoveries of pullbacks back in the direction of the trend, then those points are arguably the best places to get into trades because you have a very straightforward area, a very high probability area to place your risk management. Okay, and I believe someone said before, and it's a very useful methodology, is that you should enter into a trade closest to where you're wrong. Okay, so what does that mean? When you place your risk management, what you essentially want to do is you want to place your risk management at a point where the market is telling you that your rationale for that trade is wrong. Okay? So going back to the example of getting into a trend on a pullback, you get into a trend, it pulls back, and then turns back in the direction of the uptrend, and then you get into that point, you're very close to where you're wrong. And where are you wrong in that case? When price comes back down and stops you out right under the low of that pullback. Because the rationale for that trade is that perhaps this is no longer a pullback. Perhaps this is a reversal to the downside. Okay, hopefully that makes sense. So again, it makes a lot of sense to get into any trade closest to where the market would tell you you're wrong. Okay, hopefully that makes sense to you. Okay, now one point I wanted to make about all of this is that when we talk about divergence, regular divergence is often considered more intuitive because we're looking at the loss of prevailing momentum. So again, with regular divergence, we have a higher high in price, let's say, and a lower high in the oscillator. That's telling us that's a loss of prevailing momentum. Now, hidden divergence may be considered more reliable, as it confirms movement with the trend instead of against the trend. Basically, what you're doing with regular divergence is you're trying to pick tops and bottoms, which is fine, but generally speaking, I like to choose places where the trend will continue. Okay, so let me give you an example of that right here with this bullish hidden divergence. In terms of hidden divergence, which talks about continuation, what are we essentially saying here? Well, price hits a higher low, and then we got a hidden divergence on the oscillator here, and this is a pullback move. This is a good area to get into the uptrend if you were to be trading with the trend. Okay, if you want to go long, this is a potentially good place to do it at this higher low because, first of all, we have divergence here. Second of all, this is a pullback move. Okay, and pullbacks are arguably good places to get into trades because let's say you get in on a recovery of this pullback. This is not a great example because it just does a lot of consolidation before it finally takes off. But this is an example nonetheless where you get into on a recovery of the pullback, and then right under the low of that pullback is where you might consider placing your risk management or your stop loss, and that constitutes a very nice place to put it. Okay, a very good place to put it, a very high probability place to put it because of the fact that if price subsequently takes you out of that trade, then that's the market that's telling you you're wrong. Okay, Same thing with the bearish hidden divergence. I like to think of these as more, high probability because I'm looking to trade in the direction of the trend. In this case, it's a downtrend. Okay, so we have a lower high in price. Now, what is this? But it's simply a pullback. What is this lower high? It's a pullback within a downtrend, okay? And if we have a higher high in the RSI showing us bearish hidden divergence, then at that point, all the better reason for me to get in on this pullback with a short trade. Okay, and once again, when price shows that it is recovering from the pullback and going back in the direction of the general trend, then at that point I'm going to get in. I have a nice place to put my stop loss right above the high of that pullback. Okay. Okay. So very, very quickly, let's go through very quickly. And again, if you want my slides, please feel free to email me Chen at fxsol.com. Bearish regular divergence: higher high in price, lower high in the oscillator. Bullish regular divergence: lower low in price, higher low in the oscillator. Bearish hidden divergence: lower high in price, higher high in the oscillator. And bullish hidden divergence: higher low in price and a lower low in the oscillator. Okay, let's go to the charts real quick. I'm going to be showing you the FX AccuCharts, which is our proprietary charting platform, and it's a very good one at that. So let me go ahead and show you this. Hopefully you could all see. Okay, if you cannot see my charts, please let me know. Okay, I take the liberty of showing you some divergences here. This is on a 60-minute or an hourly chart of euro-dollar. Okay, and this is a live chart here. Where I've outlined in black, those are regular divergences. Where I've drawn in blue, those are called hidden divergences. Okay, so very simply, you take a look right here. Okay, you take a look right here. Higher high in price. Okay, we have an up run. Okay, and then a pullback move, and then a move to a high up here. Now, when that happens, okay, we have in the oscillator, and this happens to be a stochastics, slow stochastics. I got rid of the percent D line. I only have the percent K line, percent KS line, just to make it clearer. But and the percent DS is simply just a 3-period moving average of the percent KS. So for me, it's not that important in this particular usage of it. Great seeing you, Joseph, and hopefully we will see you very soon. Absolutely. Thanks for coming by. Okay, so let's talk about this euro-dollar right here. So we have a higher high in price, lower high on the oscillator, loss of upside momentum, which is showing you by the stochastics, and from there we have a pretty good move to the downside from there. Okay. So loss of upside momentum there. Okay, so then price goes down, and then it goes down, and then as you can see here, usually price or the oscillator follows price. Okay, usually the oscillator mirrors price so that lower highs in price, lower lows in price, higher highs in price, lower highs in price, etc., mirror each other. But as I mentioned before, when you have divergences, those are the times when there's an imbalance or disagreement in price in the oscillator, and at those points, we may be looking for potential turns in the market or potential events to occur, which include turns or reversals or continuations of the trend. Okay, so here we have a lower. This is also a regular divergence. This is called a bullish regular divergence. We have a lower low in price and a higher low in the oscillator, loss of downside momentum, and a turn to the side, which does occur. Okay, now back to back, we have a hidden divergence following a regular divergence. Right after that, what do we see? Okay, we see right here a higher low in the price, okay, and a lower low in the oscillator. This is bullish hidden divergence. Okay, at that point, we're looking for a potential turn to the upside. Okay, because what again is this saying? This is saying that we have a higher low in price, But that higher low in price is showing more oversold than the lower low in price. Okay, it's showing more oversold, and therefore, perhaps we might be looking to the upside for a continuation of this higher low. Okay, so it makes a lot of sense there. Now, same thing here. We have a higher high in price right at this turn. A higher high in price. This is again on the 60-minute chart of euro dollar. We have a higher high in price right here, and we have a lower high in the oscillator. Loss of upside momentum. This is bearish, regular divergence, and a potential turn to downside. And there we have it right there. Okay, so higher high in price. Lower high in the oscillator, loss of upside momentum, potential turn. Where would you get in? Where would you enter on this? Would you enter right when this occurs? I would say probably or almost definitely no. Okay, so I'm looking for other confirmations that perhaps this turn is occurring, which may include a breakout. Okay, so for example, if we were to look at this, divergence right here, we may be looking for some type of a breakout above, let's say, above this trend line right here. Okay, so oftentimes what I will be looking for is number one, for a divergence to occur, and then for other events to occur, including breakouts that are confirming that divergence. Okay, and a possibility for a reversal to the upside. Yes, you get in later if you enter here. But at the same time, you have arguably a better or a higher probability entry into a potential reversal. Okay, or you could use other horizontal support resistance levels. I have a pullback methodology that I use that talks about the oscillator emerging from oversold, and at that point, you're looking for a trailing entry stop, which is a whole nother subject in itself. Okay, but that's a potential entry as well. You can enter earlier with a tighter stop loss. Okay, but essentially what I'm talking about here is that these divergences are providing you with some prior warning, some confirmation of perhaps the directional bias of the market, and therefore, from there you could look for potential entries into the market. Chen, is there any good custom indicators that alert us when divergence occurs? That's a good question. I'm sure there are. I'm sure, I don't use indicators for that. I've done a lot of programming of my own strategies, but in terms of using, custom indicators for this type of use, I have not done that. I simply look for divergences on a manual basis. Okay, so and then here, we have this other regular divergence here. Okay, this bearish regular divergence. So perhaps you could look for an entry in this fashion. Okay, so you have you have a rising trend line here, a rising support trend line. Perhaps once you see that divergence occur, you could look for some type of a break to the downside. Okay, in this case, this break occurs right around here, which is pretty early. Okay, so from there we have several examples of bearish bearish hidden divergence here with these blue lines right here. You have a high here, you have a lower high here, we have a higher high in the oscillator. What is this telling us? This is telling us that this lower high is more oversold than the higher high. I'm sorry, more overbought than the higher high, and therefore we're looking for a potential down move and a potential continuation of the downtrend. Same thing over here with this bearish hidden divergence as well. Now, the very interesting thing here is that we have a regular divergence. This is a bullish regular divergence within a bearish hidden divergence. So what is that telling you? That's telling you that there's a correction to the upside. Within this downtrend, there could be a correction to the upside from this bullish regular divergence. Okay, so lower low in price, higher low in the oscillator, and a potential loss of downside momentum, a correction to the upside. So remember what I said before. These divergences not only tell of potential reversals in the market, they could be just potential corrections in the market, potential retracements, or even potential consolidations. Okay, so what we're looking for, the key word here is turns. Okay, so we're looking for turns. So here we have, once again, lower low in price, higher low in the oscillator. This is talking about loss of downside momentum, potential move to the upside. It moves to the upside, and then we have this completion of the bearish hidden divergence and a possibility for a continuation of the downtrend. And there we have it right there on this hourly chart of euro dollar, and a move to the downside from there. Okay. Now, very interesting here. As I mentioned before, I don't know if you caught it on my PowerPoint before. I was talking about equal lows and equal highs. Okay, these can also be part of divergences. So here we have a series of equal lows. Okay, this, if you want to call it triple bottom, quadruple bottom, whatever you want to call it, doesn't matter. We have equal lows here, and we have a succession of higher lows on the oscillator. Okay, so this is telling us perhaps that this is a bullish divergence, that there's a loss of downside momentum, or there's no equal momentum here, and a potential move to the upside, and that's exactly what occurs. And then right over here, right after that, we have bearish regular divergence and a move to the downside from there. And let's move forward a little, and that was, in fact, a turning point right there. And then we have here a bullish regular divergence, loss of downside momentum, turn to the upside. Okay, then right after that we have bullish hidden divergence, continuing move to the upside, and right after that we have bearish regular divergence, move to the downside. Okay, so these can be very, very useful in looking for turns. Okay, Boyke, great question. If equal on the oscillator, okay, so I generally don't take that as with as much importance as if there's an equal on the price, and if there's higher lows, higher highs, or what have you on the oscillator. So I'm looking for areas if there is an equal low or high on price, and then a divergence on the oscillator, then those for me are much more important than either higher high or higher low or what have you on price, and then an equal on the oscillator. Okay, I'm really not looking for those equals on the oscillator. So great question there. Okay, so from there we move further, and we have look at this divergence here. We got a higher low in price and a really much lower low in the oscillator. What is that telling you? That this higher high in price is much more oversold than this lower low right here. Okay, and therefore a potential continuation of the uptrend, continuation of these lower lows. These higher lows. I'm sorry, and a move to the upside. Okay, so that was a modest move, but a move nonetheless. And here we have the same type of thing with a bullish regular divergence. You'll find around turning points, this is in hindsight, yeah, but you'll find around turning points that this actually does work a lot. Okay, you'll see that these divergences really do give you oftentimes very good warnings of potential turns in the market, as we can see here as well. Okay. So higher high in price, lower high on the oscillator, potential turn to the downside, and we have a nice move to the downside right there. Okay, and more of the same all over here. Okay, resistance, here is support, here's resistance, and then we see price action hit a high right at resistance again on dollar Canada. At that point, when it hit that high, I'm looking for either a breakout or respect of that resistance and a potential turn to the downside. If a breakout to the upside, if price is strong enough to break out to the upside, then I would look for some follow through to the upside. But this was really strong resistance at that point. How do I watch a recording of this presentation? This presentation, I believe, has been recorded. And it will show up on fxstreet.com probably within the next few days. Great. Okay, so if you have any questions for me, after this, please feel free to email me at any time. at jchen@fxsol.com, jchen at fxsol.com. And if you want my slides, just to give you a refresher on the types of divergences, please feel free to email me as well. And I would like to thank all of you for your time today. Thank you very much.